Dear viewers, the Indian stock markets have been facing one event after the other that is making Mr. Market nervous. First, it was Adani saga, the recent event of failure of Silicon Valley Bank and Signature Bank, and now the concerns related to Credit Suisse are again feeding the fear element in the stock markets. Last time the global banks failed, we witnessed a correction across global markets, including Indian stock markets. From what I see and gather, this time the crisis is not that deep. Especially Indian banks are in a much better health than ever to withstand such macro events. That said, these events could influence money flow around the markets, including Indian markets, and liquidity in the markets impacts short-term returns. So now there is no crystal ball to gauge how various known and unknown factors combine and of their cumulative impact on the markets in the short term. So, without any attempt to predict the near-term market levels, here is my view on how you should approach investing amid these macro events. Before I go ahead, I have a question for you. If I offer you a bunch of fundamentally strong companies at fair valuations run by solid management teams, would you consider investing in them when the Sensex trajectory looks like this? You see, this is a Sensex performance over 15 years. I would not be surprised if you are hesitant. Psychologically, when you see markets at all-time highs, especially after a big fall that seems like a deep crash, you may want to wait for a better time. I know a few of Equity Master subscribers are wondering from the queries that I've recently received. The essence of these queries is something a lot of us can relate to. The query reads like this: should I wait for the markets to correct to buy stocks considering the fears of a global slowdown? Well, here is my view. Waiting for a better time or timing the markets is not the best strategy, as we will see in the next few slides. First, some comments about this slide. The time period you see is not the latest 15 years. The time period under consideration in these charts is Jan 2000 to December 2014. Notice the green triangle marking the big fall. Now here is what the long-term performance, including from the peaks in December 2014 until 2023, look like. This time span includes events that compete for being the investor's worst nightmare: subprime crisis, demonetization, the pandemic, and the ensuing inflation and supply chain distortions. The CAGR or annualized returns from the peak in the previous chart until now are clearly better than being in the cash or staying on the sidelines. What looked like a deep crash in the first chart seems like a blip now that you might not even notice if I do not place the green triangles to mark those periods. In fact, you need not go even that far in the history. COVID correction and the rally thereafter is a good example of why it does not make sense to obsess too much over the market course in the near term, as long as you are investing in the quality stocks with enough margin of safety. Now do note that this is a trajectory of the benchmark index. In last 10 years, the stock markets have witnessed stocks like Astral, PI Industries, Bajaj Finance, and many others multiply their market cap by over 10 times. The bottom line is, a careful selection of quality businesses at reasonable, if not cheap valuations could have landed you multi-bagger stock returns irrespective of how markets behaved in the near term. Theoretically, you could have made better returns indeed by entering at later correction. But that assumes that the quality stocks did correct to the same extent and that you had not been paralyzed by what if things go worse, or let me wait for a better entry point. So here is the thing. No one can time the markets perfectly all the time. Those who are right are often so by chance. It's always a 50% probability. And even if you have the rare foresight to connect all dots and variables to know market moves, it would be challenging to replicate this exercise for individual businesses and stocks in the short term. Coming to the view on the markets, we are currently at the rightmost point in the chart above. Depending on Fed's stance and the global economic events, there could be a near-term correction due from here. There is almost a 50% chance of this happening. Nobody knows. But considering the structural shifts and policy tailwinds in India, I would expect history to repeat itself. That is, a few years from now, the levels of Sensex could be dwarfed by the fresh peaks in the future. As I shared before, in my view, the base case scenario could be a 15% CAGR growth for earnings. At median P multiple of 20 times for the Sensex, this amounts to over 1 lakh level for the Sensex in 5 years. That's a CAGR of 13%, and the upside in the individual stocks that rank higher on quality and growth prospects could be much higher. However, for this style to work for you, it goes without saying that your investment strategy needs to be long-term oriented for 5 years or more. This is a long enough time for noise to get cancelled and for business-specific fundamentals to have a higher weightage in the stock price and valuations. In other words, while sentiments dictate the market movements in the short term, it is the fundamentals that drive valuations in the long term for a specific stock. Now let me share a quantitative proof of the same. I have pulled out Sensex history since 1986 until the end of the latest calendar year, December 2022, and calculated Sensex returns over 4 different time intervals: 1 year, 3 years, 5 years, and 10 years for each year since then. So, over the 36 years, had you invested with a time horizon of 1 year, you would have faced 10 years of losses and 26 years of gains. Basically, in 10 out of 36 intervals, you would have booked losses. As the investing horizon increases, the incidences of losses decline. So had you been investing with time horizon of 3 years, you would have witnessed losses 4 out of 34 times. Over 5 years, the instance of loss comes down to 3 times out of 32 such intervals. And over 10-year time horizon, you would see that there is not a single phase of loss over 27 intervals of 10 years. Now here is another interesting data for you. The chart on the slide shows the maximum and minimum gains or losses that you would have incurred under different investment horizons. Do note that anything above 1 year is a CAGR return, that is, the return has been annualized. For instance, 50% CAGR under 3 years will amount to an actual gain of 238% over 3 years. Similarly, 43% annualized gains in 5 years imply point-to-point return of 498% over 5 years, and an annualized gain of 24% over 10 years implies point-to-point return of 759% over 10 years. As you can see in the chart, for investors with shorter time periods, the chances of big losses are higher. For instance, you would have witnessed a maximum fall of 52% with 1-year investment horizon and a maximum gain of 82%. With 3-year investment horizon, your maximum CAGR gain would be 50% and worst loss would be 12% on an annualized basis. The interesting part is, for an investor with a 10-year horizon period, the worst return is still a positive or 3% CAGR and the maximum gain is 24% CAGR. Do note that this exercise is for Sensex. The fate of individual businesses could be different depending on management quality, business fundamentals, and margin of safety at the time of buying stocks. As long as you pick stocks while keeping these factors in mind, you are likely to beat the Sensex over the long term, irrespective of the global banking crisis or market sentiment. Last but not the least, long-term investing requires capacity to suffer, since there are bound to be years when the markets would be panic-stricken. A prudent asset allocation to equities and individual stocks goes a long way in maintaining the discipline and helping you to stick to long-term investing strategy. So be mindful of the allocation. That's all for today. I hope you liked the video. Please do subscribe to Equity Master YouTube channel and let me know through your comments. Thank you for watching. Goodbye.
Thank you for tuning into Equity Master's YouTube channel. If you enjoyed this video, we've got many more valuable investing ideas for you. Click the link in the description to access them now.